All right, good morning, everyone. We are live. This is going to be a special one. I think this is the first time I've ever had two lenders on at the same time. So we got Tyler on and Joel. Morning, fellas.
What's
Morning.
up?
Yeah, so today will be maybe a kind of a quick one, maybe about 45 minutes or so. We do have a um, presentation. Dion is going to present his like a dry run of his Bigger Pockets presentation in the school community today. So I think that's at the bottom of the hour. But hold on, let me
Cool.
try go live real quick on Instagram. All right, there we go. So yeah, Tyler, Joe. So there's kind of a lot of news. I don't know if you guys saw the data today. Also, the inflation. Things are looking dicey out there. So maybe Tyler, you can touch on what direction you think mortgage rates are gonna go before Joe touches on it, and maybe like we said, should people lock it? Something that they're seeing now, or should they wait? What's your thoughts?
Yeah, I mean, so mortgage-backed securities the last 2 weeks have definitely dropped. They're dropping today. We got the 10-year Treasuries down to 4.06 right now. PPI numbers came in, and the employment numbers last week I think really helped us, right? So everything's going down. So a short answer to your question is it depends. Like, what are we trying to do? I had some clients that I talked to this week that I said, hey, let's hold off a little bit and then see where things end up. And then there's some people where it definitely makes sense now. Like a lot of my VA clients were just taking some of the chips off the table. They're like in the mid to high sixes, and we're getting them low 5%. So they're saving a good chunk of money, and then we can revisit it down the line. So I think like anything, and I'm guessing most people would agree, to answer that question, it depends on like what strategy are we trying to use, and then like what is their end goal.
All right, great little breakdown. So Joel, same thing. Your thoughts of the data you're seeing out there. Do you think your advice would be lock it if you like it, or kind of same thing? It's kind of it depends.
I mean, if you're buying a house, right? I mean, I always ask the question, what's going to be more significant, the pain of rates going up or the benefit of rates going down? And then let the clients decide. But we're kind of in a unique little time frame. You have the Fed meeting, I guess, was it next week? And I've talked about this on my channels. That I think what's interesting, if you go backwards in time to 2024, there's a little bit of a similar setup where July they hold rates steady, September they end up cutting, and then the day they cut rates, the bond markets it shot up from there, all the way up from 3.6 range in the 10-year Treasury up to like 4.8 at some point in the future. And I, at this point in time, I mean, all bets are that the Fed's going to cut rates. We haven't seen a huge drop on 10-year Treasuries. We have seen a little bit of a drop once they announced in July the revision on jobs. So I wouldn't be surprised if they do a 25 or I mean, I think they should do a 50 basis point cut. That's what I think. I mean, businesses are not investing; they're not growing. And people talk about housing and mortgage rates and all that stuff, but at the same time, I mean, if businesses are not reinvesting in their own business, that's going to stall job creation, and we're seeing the job creation get hurt really bad, and with some of these revisions. So, I don't think any of it's major, but I do think it's a signaling for, 6, 12 months to come.
Tyler, so kind of what is your thoughts? Joel kind of touched on it. Maybe he's thinking a 50 basis cut. What are you maybe thinking or seeing?
I think I agree. I think that the market's kind of priced in a 50 basis point cut. So it'll depend, right? If they don't, we're going to get a reaction, and if they do, it'll probably be a minimal reaction. I just think, with the crack showing 900, what was it? The revision of 900,000 jobs, things like that. There's going to be enough pressure to where, yeah, I don't think they're not going to cut, especially with inflation numbers coming out in a friendly direction for them to cut. I think that'll help out a lot. But I do think, yeah, I'm curious, like what Joel's seeing. I'm not super familiar with like your day-to-day business, but like for me, I'm noticing as soon as we get any news in regards to rate cuts, phone activity is picking up. Activity for people that want to get pre-approved or people that have been sitting on the fence, they're at least touching base. So I still believe as soon as rates drop, I think we're going to have a lot of activity in the purchase market. I could be wrong. It's all anecdotal, right? As soon as it happens, my phone starts to ring. I see, deals are being put into escrow, and I don't need to make it more complicated than that, I guess, because we're on the front line seeing it day to day.
Joe, what is your thoughts on that too? Like, I mean, how would you maybe explain yourself, what type of lender you are, and then Tyler can also maybe explain what
Oh
type of
yeah,
lender he is, and what type of like are you seeing business activity pick up right now?
yeah. I mean, my business. I live in St. Louis. I'm licensed from the Maryland, D.C. market, Virginia to Florida to Texas. So that's really the core of my business. And then as years have gone on, I've worked with a lot more investors, so DSCR loans, and then started getting to more 5-plex, 12-plex, 20-plex, things like that along the way too. I've seen some investors start to go on the hunt. Well, once we started seeing that July report, revision of jobs, I saw investors go on the hunt trying to really get some aggressive deals under contract, just because the writings on the wall of rates starting to come down, and we all know that if rates start to go down significantly, that everybody on the sidelines is going to jump back into the game. It's going to put more pressure on prices. And so I'm not saying everyone's getting a deal under contract, but they're out there hunting and searching for deals. And so that's really, specifically for my investor clientele. And I got people that are hunting for quadplexes in Indianapolis, in Omaha, in St. Louis, in different parts of Texas, in different parts of North Carolina. I've seen some more activity of people pulling cash out of some properties. I've had a lot of people with properties free and clear say, okay, now it's time to put some chips back on the table, which I think is interesting.
So what about you, Tyler? Maybe explain what type of lender you would be kind of classified as, and maybe what are you advising your clients also? And like same thing, has activity picked up quite a bit for you?
Yeah, so day to day, I do mainly conventional lending, VA, FHA financing, and most of my target audience is first responders. As a first responder, firemen, police, anybody like that. That's my day to day. And then on the side, I'm still doing. Well, not even on the side. My hard money business is picking up. But yeah, the majority of my business is still that conventional side. And people are asking, and I put it on my Instagram all the time. I always tell people that I'm still a huge believer in time in real estate, not timing real estate. And for a primary residence, if you are looking to buy and you have the capital to do so, and the payment makes sense now, I always suggest it, because you're not going to regret it. I mean, I still say that same thing. I don't like the whole, what do people say, date the rate, marry the house, stuff like that. I just think that's a little cheesy, but I just look at it. Joel touched on it. If the rate makes sense and the payment makes sense when you're doing that qualification process and you can lock it for a purchase, I would suggest doing so. Most of the time when we try to get greedy and I try to get an extra quarter point or something for somebody, it ends up backfiring and we wish we had locked it at that point. And over the course of things, everything's going to shake out. And if we are thinking that we are going to go into a declining rate environment, why not secure a house now at a rate that you're comfortable with the thought in a year or two that, logically rates should go down a little bit more and you're going to be even more comfortable. But I qualify everybody on today's rate, the payment that they are comfortable with, and we go from there. I think the biggest thing too is people always are so focused on rate or the max qualification that they can go for as far as a loan amount. Make sure you always have a payment that you're comfortable with, not that's going to stretch you thin. I talked to a young fireman yesterday, and he said, dude, I didn't understand how expensive owning a house was. And I said, well, yeah, that's why we don't want to max out our approval, because you're going to need some more discretionary income when repairs come, things like that.
Yeah, I just quickly want to remind everyone, if you want to maybe get some rate quotes or touch on investing and strategies, reach out to Joel Tyler. I put their pages and YouTube channels in the chat, so you can go follow them and reach out to them and see what maybe they could help you with. I think a lot of times, maybe the biggest question I see, like in our school community or in a lot of group calls and whatnot, people are always trying to determine, like, should they buy down the rate, or pay? Should they have a prepayment penalty in place? So how do you guys advise your client? Yes, and Joe V's here, your favorite guesses here, Tyler. But how do you guys advise people on that point? So Joe, maybe if someone reached out to you thinking about buying down a rate, like how do you maybe run that through them, that scenario?
Yeah, I mean, you look at the difference between the payment and the cost, and you start to calculate, well, if I pay X amount of dollars upfront at closing, how many months is it going to take to be able to accrue and capitalize on savings each month to get to that same dollar amount that you pay? And I hate rules of thumb, but my rule of thumb is that if you break even within 36 months, it's probably worth digging deeper on. If you're over 36 months, I mean, I don't know, it's maybe not the best deal. But there's another thing that I think is important too, is that when you look at especially if you're talking about DSCR and prepayment penalty, the smaller the loan is, the smaller that the impact of let's just say a 1% drop in rates versus the bigger the loan is, 500K versus 100K, the bigger the loan is, the bigger the impact a 1% drop would be. So the lower the loan is, it's really going to have to go, the rates have to go down a lot for a refinance to make sense to do. And so when you do the math on it, you're going to be probably more inclined to pay points or maybe even do a prepayment penalty scenario on a smaller loan like 100K or 80K or whatever versus a larger loan size where it takes probably more analysis to really dig deeper into. But I mean, the break even is really kind of the starting point to analyze.
Tyler, what about you? What was that? What do you think of that breakdown Joe gave? Is that kind of how you would advise your clients also when looking at that type of situations?
Yeah, that's exactly what I do. I take what we're going to pay for the buy down, divide it, see how many months it takes, and then see if that makes sense for their plan. If they have a 5-year prepay and they're planning on moving in 3 years or selling and getting another property, doesn't make sense. And I also agree, depending on the loan size, if like I have a couple rentals that the loan amounts are right around 100 grand. It's like, well, a prepay for that, it's not going to be anything significant. So I don't worry about it. But for the consumer for buying a primary residence, I always look at our rates expected to go down, stay flat, or go up. And I think right now, I would not have even if they don't go down right now, I would not buy down the rate if I feel like I'm paying for something that I could get for free or at a cheaper price later on down the road, right? Like if they're paying to buy down to 5%, but I think that all signs point to that they could be there in a year or two, then why are we paying a few $1,000s? Especially my market loan sizes are usually around $800,000 to $900,000, so it's going to be a significant cost.
All great points.
What market are you in, Tyler?
Southern California, like Orange County.
Okay. Yeah, definitely big one.
Yeah, he's in the big, the expensive place. Yeah. But I did want to touch on Tyler. You also mentioned you also do hard money lending and whatnot, right? So do you lend all across the country, or how do people, get in touch with you for that type of stuff?
True lending, no. I just want to stay to California, but I have options for hard money loans in other states using institutional financing. I'm signed up with a lot of Kiavi, RCN, things like that, and I can help them out.
All right. So Joe, has your phone been blowing up recently, or what? You seem a little busy out there every time I message
Oh
you. That's
yeah,
why.
yeah. I mean, we're busy. We're definitely busy. I think it's interesting just to give a blueprint. There's 3 categories in the past couple of years that I've seen people be active, and it's really hasn't been much in between. Somebody that has a life change, whether it be downsizing, divorce, things like that. Your first time home buyer, and then and your investors. Like those are the 3 categories of people that I'm seeing most active. There's obviously exceptions to that rule, and it's not until just recently, and I probably say in the last 3 months, because I mean I do a lot of outreach to my database, and one of the biggest things for people that already own a home, that when they're starting to plan for the next property, whether they're going to sell it, rent it, et cetera, is that a lot of people are dipping into equity. They have a line of credit set up for the next acquisition, whether it be buying a rental, buying the next house as an upgrade or whatnot. And so a lot of HELOC activity as well in the last couple of months, which is a precursor to people getting on and shopping for houses.
Go ahead, Tyler.
Well, I'll say, do you think? I think I agree. I think a lot of people are using HELOCs almost like a type of bridge loan in some instances, right? Yeah, at a much cheaper rate.
Well, yeah, I mean, and that's the thing too. Just like we're talking about private money, right? I mean, here in St. Louis, I know a company that's the best one in terms of just the volume, and their standard is okay, good credit. You're talking about 12%, 3 points, and if you've got experience, you may not even need a whole lot of money in the deal if you have the ARV and you get a good price on the deal. But 12% and 3 or 4 points, right? Versus if I have a HELOC, especially if I have a HELOC on an investment property. I had somebody that was analyzing this recently. There's a HELOC on an investment property, prime plus 4.5, I think was the rate. So what is that? 12 or 13%? I don't know what the number is. So if you're analyzing a HELOC versus private money on just acquiring a property for a fix and flip, well, the HELOC, it's a similar rate, but then you're not going to have the points, and you control the disbursements as opposed to going through a third party. So I just think those are some of the things, the questions that some investors are coming up against.
I want to touch on Jay Smith. I haven't seen you here before, but thanks for tuning in. But I don't know if this is a question, or maybe they're just kind of pointing out maybe their take on the housing market right now. But they're saying boomers dumping homes soon enough. Demographics suggests this is the mid IQ take. Do you guys have any thoughts on that? Is that kind of where you'd be looking at it, where that's what you see coming up in the next few years? A lot of boomers just dumping home, flooding the market.
I mean, some of my clients are selling. Yeah, they have larger houses. They're downsizing. But I haven't seen like a large scale, as far as my own business goes. No, I have not seen that.
Joel, any thoughts on that as far as boomers flooding the market with housing in the next few years?
I mean, and I've heard people talk about, well, if rates go down, there's going to be a flood of homes hit the market because there's a lot of pent up demand, people wanting to make a move, upsell, downsize, etc. I don't know. I just don't see that because there's just so much information and content out there about home real estate as an investment vehicle that I just don't think you're going to have the same type of sell off. You're going to have more people keep properties as rentals because the information's there. And especially if you've got a 3% rate, why are you ever going to sell? I mean, if you don't want to manage it, that's fine. Go get a property manager, and because rents are continuing to go up. So until that type of data starts to really flood the markets, I won't believe it until I see it.
Do you think that is possibly though because we are, all three of us and a lot of the audience here, and we're kind of in maybe the center of the housing space, I guess. That's kind of maybe our primary investment vehicle. That's your guys jobs right now as far as lending side. But I feel like I see so much of the younger generation talking about like the headaches of home ownership, rental properties, and there's so much other ways to make money with less, I guess, headaches in a sense, right? Whether you're putting it in Bitcoin, whether you're putting it in the stock market and things like that. So do you think like real estate as an investment is still a good asset class to be investing in? Tyler, maybe your thoughts first.
I mean, I do, but that's also because that's all I really know. But I just think like that we have a fundamental need for housing, and until that changes, it's a good investment, and it's for so many reasons. The reasons that it's always been right, depreciation, all kinds of things like that. Appreciation with cost segregation now, it makes it even more attractive. There's a lot of things that you can do that make it even more attractive. But I agree, like Bitcoin, things like that for a younger generation is much more like enticing, I guess. Maybe a lower barrier to entry. So I don't know. I just think real estate, in my opinion, is not sexy, and it's never really going to be. And the things like Bitcoin or stocks, it's way more sexy to talk about, hey, I'd put money in Bitcoin and I made X amount than, oh, I'm getting $200 a month positive cash flow on this rental I have, and it'll pay off in 10 years. Like, it just doesn't sound the same, right?
Yeah. Joel, I see a lot of people. I believe they're tuning in from your channel. I'm not sure if it's your channel or maybe Tyler's channel, but
Mhm.
I do see like so it's maybe a question. They have a where did it go?
One was HELOC versus a cash out.
Yeah.
I love that question, and I think um, it's important to know what the purpose and the use of the funds is one thing, and also two, the timing. Because let's say that you talk about rates, a HELOC is going to have a higher interest rate than a fixed 30-year on an investment property, whether it's DSCR or just regular conventional. But you're paying interest on the full lump sum when you have it completed, right? So the whole lump sum is coming to you, and you're paying interest on the full thing. Let's just say it's 200K. Whereas if you do a HELOC, you're only paying interest on what you use. The rate's going to be higher. So if you're using it in kind of mad dashes, let's just say you're going to do a purchase of a property, fix it up for 2-3 months, and then flip it. I mean, maybe you're better off having a HELOC to where you can use it, execute your plan, sell it, pay it off, and then rinse and repeat. So I think the use of the funds, I think, is the most important thing.
I would think that Tyler probably has the same answer for cashing out or HELOC. Is that
Yeah, I mean, different purposes, and it's all everything. It's like you have a tool belt, and you have different tools that you use for different jobs and different reasons. I love HELOCs for their flexibility with clients who maybe it's also good equity protection too, right? Like if you never use the HELOC, but you get it and you're not drawing, you're not really paying, and you're not paying on anything, but you have it should you need it. And as long as it's not to go buy a boat or a car or something stupid, and you have to have that conversation a lot, it's a great tool. But then there's also great reasons for a fixed cash outs, whether it's your first mortgage, or if you do a second lien, right? If you do a second lien, like a HE loan, that's why I love doing this. There's no limit to the creativity, right? Like everybody loves real estate on the investment side because it's creative. You can structure deals a million ways. You can also there's so many different loan products now. You can also there's something that's going to help you accomplish your goal. And I would just say, and I'm sure Joel has these conversations too, is 99.9% of the time everybody calls me, "What's your rate?" And I'm like, why does that even matter? And it sounds stupid to say that, but it's like I have no clue what you're trying to accomplish. What are we looking to do? And then rate is important. Don't get me wrong, but it's not like number one on the list. And I think it goes back to your question mark. Products are important when we find out what you're trying to do. And I have clients recently trying to get out of credit card debt. We're putting them into a HELOC. They're going to pay it off, and it'll be awesome because should they need anything again, they're not going to use their 39% credit cards. They're going to use a HELOC with a much lower rate. Both financially responsible individuals. They had medical issues. They're self-employed. They had to do what they had to do. They're back on track, and it's going to be a good thing. If they weren't, I would say let's do a fixed second, to where they're not going to be tempted to use that checkbook option on the HELOC and rack up a bunch more debt.
I love that advice. So Joel, that individual is following up. They're saying, "Don't buy Bitcoin; it's outpriced. I was going to use it to buy another property." But
Yeah, I mean, in that case, you're talking about getting a loan on the new property, right? Which is probably going to be a 30-year fixed instrument. So in that case, if you're going to pull cash out of a property you already own, I mean, I think it definitely leaning towards making more sense to just do a regular 30-year fix on the property you already own, and maybe even buy it straight cash, right? If you have enough equity there to pull out, buy the next one in cash, maybe get a better deal on it, have more bargaining power, certainty on the deal, makes the seller happy. And then down the road, then you can always look at pulling cash out of the new one if you need to leverage that for future purchases. But one of the things I want to throw out there too, talking about, throwing money into say a Bitcoin or a stocks and bonds and, day trading or whatever, the excitement, right? There's no panic selling in real estate, which, is a good thing. And on this channel, Mark, you talk about, the 5 years of suck, right? I mean, real estate, it's a slow game. So I think coming out of the 2020, 21, 21, low rates, prices going up 30, 40, 50%, I think it gives kind of a missed expectation what people should be expecting for real estate. It's a slow game, right? It can open up amazing doors as you build equity and build connections and build opportunity. But I don't think we're going to see the same 15-20% of appreciation like we saw a couple years ago. And so maybe it's back to the 3 or 4%. I don't know what it's going to be, but if you're looking at it from a long-term perspective, especially the cost, if you're a high income earner in some kind, the ability to cost segregate and bonus depreciation, I mean, that is what I call the holy grail of real estate, because I literally have a doctor that I just got their tax returns a couple weeks ago. He's got a line item of $240,000 of depreciation from, a cost seg study, and he made over $500,000 a year. He just cut his taxable income in half just because of owning large amounts of real estate. So that the people that are making high income, it's a game changer.
Yeah, we got Deconstructing Dreams here. John Litz. He is hopefully resting. He's had a urgent eye issue. His retina is slightly detached, I believe. So he had to go to the hospital this weekend, and hopefully he's following doctor's orders and resting up. But he's tuning in, and he's talking about the kind of the boomers flooding the housing market. The silver tsunami we've heard about so many years. But he says, talking to Hyder, he says, "Yeah, I think you're right. Hearing about the tsunami for quite a while now, and it's been a huge nothing burger." And then Hyder is replying to that person from your channel, I believe, Joe, talking about Bitcoin being overpriced. Hyder's, I'll be your bag holder, right? So Hyder is definitely a big believer in Bitcoin. And I saw Nick here earlier. He's actually a teacher. He's in Thailand. He's in California. He was in real estate. He still believes in real estate. He did the house hack. He built an ADU, all those type of things. But he sold a lot of his real estate and went all in on Bitcoin. He had a HELOC. He went all in, and so yeah, he's doing really well. So he has a YouTube channel also now, Lead Pray Hodl, and he's definitely all in on Bitcoin. But I love his content. He's on my channel regularly now, and I'm trying to dig deeper into the Bitcoin space because yeah, it's just another asset class, right? But anything else you guys want to dig into, like the data we've been seeing? I think what comes out tomorrow, there's another report. Is it, I forget another inflation report.
Here, I'll tell
Yeah.
you. I have my econ calendar with me. Hold on. And while I'm looking at this, somebody asked, are you getting a lot of requests for ADUs to build? I personally am not, but I was speaking with a large home equity lender, Spring EQ, yesterday, and he said a lot of his clients are actually that they're using those products to build ADUs, especially in California. Tomorrow we're getting core CPI, so that will be a big one, right? And then next week we have the interest rate decision on Wednesday, which will be a big one, obviously.
So as of right now, before the CPI comes out tomorrow, so I think, Joe, you said you think it should be a 50, right? Or what do you think it's going to be, though? Just based on what we're seeing right now without tomorrow's information.
I mean, I think they should do a 50 basis point cut. That's what I personally think, regardless of what the data shows. But I'm always what would cause the most pain in the market? Like what would have to happen to cause the most pain in the market? Because again, when you have pain in the market, then you have massive swings. The people that are institutional traders, they make money, going both ways on it. And if for some reason the Fed does not make any cuts at all, which is like, if you look at, poly market, it's like a 5% chance. If they don't make any cuts and they rationalize it some way, I mean, the stock market's going to tank, just like it did with the whole tariff thing back in, was it May? I mean, the S&P was over 600. It, blew up down to 500 or so. If the Fed does not cut rates, you're going to see probably something similar. And then at that point, you're going to have more pressure for rates to go down, which is what Trump wants, right? He wants to refinance the national debt at lower rates. So I don't know. I'm at the point where no telling what's going to happen, but I don't know. What are your thoughts, Tyler?
I think so too. I think you have to do it, right? Like, not have to, but I think everything's pointing to that. And you touched on it. We have to refinance our national debt. I think that there's enough showing, especially like, the PPI that came out today was a lot cooler than they expected. And the big thing was, from what like last year, the year before, is housing was one of the largest portions of the inflation data, right? And we're seeing that that's stabilizing. So okay, well, that's been your argument forever: is housing's too hot, housing's too hot, housing's too hot. It's starting to cool, and if we're all looking for, what is it, the buzzword soft landing that they've been talking about forever, it's like, okay, well, it's time to feather the clutch. Like, I agree. Like, I would look at it this way: are we going to have more pain if we don't do that 50 basis point cut, or if we do? And I think if we don't do it, granted, they can change the rate whenever they want to. That's the thing. It's not like they have to wait for their Fed meeting. But yeah, I think they're going to do it, and I think it would be smart to do it. And I think a lot of consumers, it would give them some breathing room too, and just with these cuts throughout the next year or so.
So with both of your guys' thoughts, so like you guys are both expecting rate cuts, and as Hyder always likes to mention, and other people like to always make sure people realize that just because they cut rates doesn't mean mortgage rates are going to go down. And like last year, right, they cut rates and mortgage rates actually went up. So you guys are both thinking they should cut rates, they will cut rates. Do you guys believe that mortgage rates are going to come down? I think Tyler, you touched on, you thought it was baked in already slightly, but so do you guys think mortgage rates will come down if they cut rates?
There's no direct correlation, right, with the Fed funds rate, but I do think so, because I think it's just a signal. It's signaling to the market that that rates are coming down. And I think, yeah, I think the MBS is right now, the way they've been dropping. I think if we get a move in coupons, then I think it's going to benefit us. And right now, when we're on the phone, I'm just getting, hey, I'm looking to refinance. It's like, it's people are starting to do it.
The life of a lender, huh? So, Joel, so
Yeah.
you same thing,
Right.
same thoughts. You
Yeah, I
feel
mean,
like
one of the things that Tyler mentioned was marry the house, date the rate, marry the house. I forget the exact terminology, which I hated that thing, by the way, as we've seen rates not really go down much over 2 or 3 years. But if I go backwards in time, I made a video on this. This was back in, I think, April or so. The bond market started going down, and within a 48-hour stretch, I had a couple people that wanted to refinance miss the mark. And I gave the illustration of, hey, bond market's going down. It was at 4.2, and then it gaps down to like the 4.1 level. So I get a phone call from a client. Hey, I want to look at numbers. I gave them the numbers, and then that night they talked to their spouse, and then we set up a call again just to reconfirm things the next day. And by that time, the market's already it's down, but it's moving up, and then they don't apply until middle of the next day. And at that point, the bond market had already gone over 4.2. So within 48 hours, it dipped, bottomed, and then right back to where we started from, above where we started from in 48 hours. And so if you're trying to time the market, sometimes it works, sometimes it doesn't work. And I've had a target for 10-year Treasury for a while now that I'm hoping it hits 3.6. Right now it's at 4.05, under 4.1.
Yeah, right there.
3.6 is kind of where it bottomed out last year, ahead of the Fed meeting. So I have a few people that we've started the process, and we're just floating the rate, and then because they're in process, if it hits that mark, I can lock it in. But if you call me the day that it hits that mark and you want to lock it in, guess what? You're 40 seconds in line behind everybody else that's already in process. So it's good to be having conversations ahead of time and not be reactive and wait. So talk to your lender.
Yep, talk to your lender. Reach out. There's Joe's YouTube channel in the chat, so if you want to connect with him, Tyler's Instagram page, if you want to message him and see how they can help you guys. I do see. I haven't seen. So WireNut, haven't seen you here, but thanks for stopping by. But WireNut says rates don't matter. Prices way too high. Do you guys have any thoughts on that statement,
I
Tyler?
have so many thoughts.
Ooh, okay, Tyler first, maybe though.
I mean, I get that prices are high, but I don't think I think he's referring to that we're going to have some major market correction or something in order for people to buy, and I don't think that. I think, like I said, just anecdotally, like with my day to day, as soon as rates drop a little bit, people are jumping in the market. And to that point, I have a lot of cash buyers right now that are buying primary residences with cash too. So people are like, these are sophisticated people who have, one of them was a $4.3 million offer, all cash. It's like most people who have that kind of discretionary income to put down on a home are not, fools. I guess you want to say, like, they understand the market and they're not afraid. They're parking their cash there because they know that over time it's going to be a good bet. So I mean, I agree prices are high, but I don't think that's the reason. I think affordability is the reason. And when rates drop a little bit, I think it'll increase the buyer pool. I think they say 1% is 5 to 6 million buyers.
Joel, your thoughts on that statement?
I mean, just simply, the crash has already happened. It's just not happening in price, and this is what Zuber talks about. The crash is happening has happened in the transactions. I mean, I know so many people who, hey, I want to sell XYZ house, and it's on the market for 180 days. It's just sitting there, and they're not getting the price that they want. And then if they don't get the price they want, they'll just take it off, and that's happened so many times. And I think I forget the numbers, but the number of houses that have been on market that have been taken off, I mean, it's at record numbers just from one of the reports I read in terms of percentage or whatnot. But I don't know. I also, talking about the one rental at a time community, so many of that community is in a high cost area like a Washington or California, and they're out there navigating the real estate game in other markets, whether it be in Ohio or Indiana or, Missouri or wherever. So, I mean, the prices may be high in your market, and you don't have to play the game, but it doesn't mean other people are not playing the game.
I did see something on X that was kind of interesting. They were talking about a lot of this information, that we get weekly, the jobs data, and as you've seen, it's all been revised, right? Every revision, it goes down or up. Actually, I mean, but basically, it's hard to keep track of what the actual data is, right? So someone was saying almost like, why do we even have this data put out monthly? Because basically it causes such a confusion in the markets, right? So we get this data, people react to it, then they revise it. So it's kind of like, why do we even use it? And then the other part of it was, with technology and AI that we have today, why are we using this old, I guess, style of getting this information, and it's always lagging, and we're putting it out there and basing our economy, almost our decisions, on this lagging or kind of maybe outdated way to get this information? You guys have any thoughts on that?
I agree. I mean, how could you be a million jobs off, right? Or whatever the revision was. It's just crazy. And to me, I mean, so I would say, I don't know what you guys think. I'll put my tinfoil hat on. There's a reason you're a million jobs off. I mean, there's no other answer, in my opinion. You can't, maybe 1,000 jobs off, 10,000 jobs off, and the whole thing. But we were off by a million jobs. I mean, I don't get it. Yeah, so I agree. I think real-time data is so much more readily available, even for like the average person. We can access almost anything instantly at this point, and you can, so I think it's all crap.
Well, I'm laughing out loud because there was a video recently on talking to Musk, and they were asking him about his time with the government, and I think they said something like, oh well, yeah, he hasn't been to DC since May, and this and that. And Musk's comment through some of the questions was, the government is unfixable. Like they were trying to go in and systematize things, make systems better and technology better. And his quote was, the government is unfixable. And I think that just goes to show, I mean, if Musk, who puts rockets into space and reusable rockets and changing so many things, if he says the government's unfixable, I mean, I think that goes into what we're saying. Like, there's so much fraud and stuff going on within the government that, I don't know.
Yeah, I think what was I saw something else today. I thought it was a great kind of quote or whatnot. But someone was saying, it was on a podcast. It doesn't matter if you study finance, but your finance cares about what you know, in a sense. Wait, what was it? Was that how it was? Finance. I forgot. I gotta look it up. But it was basically saying that you don't have to really like know in detail and studies all these things in depth. But if you don't have some understanding of it, financially you'll be impacted in a sense, right? So I think that's the takeaway is like this saying, this data, this information. A lot of times, we don't want to be making our own personal decisions based on what we see. Because as we're seeing, like we're saying, we're lagging, maybe misrepresented or whatnot. But we do have to have some understanding, kind of, to see, how people are making their decisions, or what the market is seeing, and how we can kind of prepare to win. But let's. Oh, Troy stopping by. He says, Troy said, the problem is that first-time home buyer has perception of what a fair home value is to them. For the last 3 years, it was rates are too high and homes are too high. That's because they're basing on pandemic rates and 2019 prices. Yep. Uh,
Yeah, and you have recency bias, right? Like all these people see 2% rates and they think that's what it needs to go back to for them to buy a home. But in reality, like 20 years ago when we were refinancing people at 5% or 6%, they were doing like the happy dance. Like they thought this was phenomenal. And yeah, I think a lot of it too is recency bias. And to your point with the crash already happening, there's some, do you guys know who Bruce Norris is in California? Well, now he lives in Florida, but he's like super well respected. He has, for the most part, pretty much been on point with everything. I like the way he calls this. He says it's going to be like the lost decade. He's like, we all experienced the next decade of appreciation in most housing markets during the pandemic. So it ramped up so fast. And he's like, well, now you're going to be flat for 10 years, which I think we've talked about this before, Mark. I would love for a flat market for a real estate investor, I think is a beautiful thing. Like if I can expect this for 10 years, I can make a lot of educated decisions. And in 10 years, you could crush. I mean, in 5 years, if you were to just put your head down, you would be in a really good financial position. But yeah, I don't know. I'm not sure if you guys follow him. He's not as active anymore as he's getting older, but I love listening to him. And I'm going to go to, in October, I think he'll do I Survive Real Estate. And the last time I heard him speak, he called it the lost decade because of the amount of appreciation that we had.
Like I said, I think you brought his name up before, and like I said, it's funny how things kind of relate. So, Bruce Norris is always mentioned by Michael Zuber as the individual that kind of maybe saved his portfolio or made him pivot into what he was doing. So when Zuber was kind of in the beginning part of his journey, I believe it's how he turned 8 homes into 80 units or whatnot. But basically, I guess Michael Zuber went to a event, and Bruce Norris was talking about the unaffordability, the housing unaffordability in that market that Zuber was in. And he was talking about a crash coming. And sure enough, Zuber reviewed the data, reviewed the information, and said, okay, we're at kind of like the peak in a sense. There's a crash in a sense coming. He got out of his properties in California, or not in California, but where the market he was in, and then he 1031 whatever, he transitioned into 80 units in a sense, and that's where his trajectory took off. So it's funny how you mentioned Bruce Norris, and it relates to kind of Michael Zuber's journey also. And the thing that you touched on, you said you're going to see an event in October, and like I mentioned earlier, we'll probably be wrapping things up about five minutes or so. But Dion is going to be speaking at the Bigger Pockets event. I believe it's in October, so he's one of the keynote speakers. So he will be going live in the school community in about 15 minutes to kind of dry run his presentation and kind of give the school community a little sneak peek at what his presentation will look like. Hyder says, here's the
He
Chuck
is.
Norris of real estate investing. Hey, Andy's here. Andy just came back from Jack's Pittsburgh event. Jack had a in-person meetup in the Pittsburgh market, so that sounded like it was a lot of fun. But maybe I know Flavio, I skipped over. Flavio did have a question for you, Tyler, before we wrap things up. He said, do you still flip in Idaho?
I do, but like I think I've said before, I'm not anywhere near as active as I used to be in Idaho. That was like my main focus. I still have marketing going, I still have rentals there, and I'm still like looking, but it's not like my main focus. I'm learning to be more patient over the years, and it's like, okay, I had from 2017 to 21 there, I had a phenomenal run. So it's like, why not wait until I feel like I'm in a position to do that again, whether it's in Boise or another market, and then do it.
Hyder. So, and then also the funny thing is, Hyder. So Zuber also talks about like his first property, investment property. It's on Norris Drive. So yeah, yeah.
Foreshadowing.
But so maybe Joe, you can wrap us up with one of Flavio's questions is, what do you think about farmers losing their harvest because of lack of farm workers? Flavio is touching a
Uh,
nerve with Joe.
I think I
2
want to answer that
minutes. Come
question.
on, Joe.
I think I want to answer that question.
Don't get me canceled, man. Hey,
Yeah,
J6
yeah. Can
here.
we talk?
I was on a farm last week, and he did not have that issue.
Yeah, can we talk about GameStop for a minute?
Go ahead. You talk about what you can talk about. Yeah,
I
whatever
mean,
you
they're
want to
going
talk
to
about.
issue warrants if you own it on record by October 3rd, and there's a lot of phantom shorts out there. And then it kind of goes back to my philosophy with all this. I use the word, cost seg as the holy grail of real estate. Like, all I want to do is make as much money as I can to go buy more shit, whether it be real estate or Bitcoin or GameStop. And so the AI revolution's on its way. So, it's up to us to go figure out how to go generate more revenue. Stay Winning Pot always talks about multiple income streams. And Tyler, you've got private lending, you've got real estate, you've got regular lending. Anything else that you're into that's generating income?
No.
Pension.
That's it.
A pension.
What's that? Oh, I do have
Okay.
a pension. That's nice. Yeah, the pension's definitely nice. So yeah, you're right. I do have a pension, which it's like, yeah, it's that drives home passive income. It's nice every single month, no matter what happens. That check shows up.
Let me throw your guys' information in a chat before we wrap things up so people can reach out to you guys. But I see a lot of people tuning in last minute. Like I said, we got J6 here. He's in Jersey. He spoke also at the Pittsburgh meetup, but he was also there to check out the area. But he was talking about AI. I see Ike here, who's a firefighter in Kansas. He's working on a rehab right now. Who's anybody else tuning in recently? That's about it. But let me put your guys' information there, and then John, like I said, he's hopefully you're resting up for your detached retina. But he says at the end of the day, it's all about the monthly payment, regardless of interest rate or price. Can they afford the monthly nut? Is what matters most for most regular people. Investors are more educated. All right, let me just put your guys' stuff there. Let's wrap things up before anyone mentions the Bears game. I was very upset at what happened there. But hold
People
on.
hating on Caleb Williams, calling him a bust, calling him horrible. Oh my goodness, it's just one game.
Well,
I've always thought he was going to be a bust, and I'm a SC fan, and like I just
wait. I didn't know. Why do you think he always going to be a bust? Like, why's your thoughts about that?
I just think he's overrated. I don't see it.
All right. Well, I won't have you
And
back
I'm
on
not
the
hating
channel
on the
anymore.
Bears.
I guess
at
you
all.
won't be on the channel anymore then.
I know. No, I'm just saying. Hey, I'm not hating on the Bears at all. It's like, do you have a college team?
No, not really.
Okay, so I don't know. I see
I'm a
lot
St.
of-
Louis Rams fan, so there you go.
There you go. St. Louis Rams now in LA with the LA Chargers, who should be in San Diego.
Hey, Curtis is here. What's up, man? You must be on, let's see, your teacher's break or something. But everyone, just a reminder, Dion's going to go live in school in about 10 minutes. If you have bought your Vegas event tickets for the ORAD event in February, reminder that Michael Zuber is having a special live 6 p.m. Pacific tonight for those that have already purchased their ticket. Yeah, we'll see. I lost 2 fantasy leagues because of the damn fumble by DJ Moore at the end of the game. His stupid lateral cost me like negative point, and I lost 2.
Yeah.
All right, fellas. Thanks for doing this. Glad you guys could jump on. Great information. We'll see where rates go. But if you guys, people out there, if you're looking to buy, want to know how they can help you, reach out to them and see what they can do for you guys.